The next topic we're going to cover is internal and external range liquidity. This lesson is what's going to be the turning point for most of you. This is what makes bias easy. You really want to get your notepad out for this one, guys, and understanding the relationship between these types of liquidity will unlock your ability to read price action. Also, very important, backtest as always. We're going to be talking about time frame alignment. We're talking about monthly levels into a daily structure. We're going to be using weekly levels into a 4-hour structure. We can use a daily level into a 1-hour structure. So price is fractal, right? So understanding external to internal, we can use these different types of levels on the monthly, weekly, and daily levels and using their corresponding structure on the daily, 4-hour, and 1-hour. The relationship between internal and external range liquidity and how they interact is the key turning point in really understanding where the market is likely to draw to. I consider this lesson one of the most important, if not the most important one in the mentorship. So grab your notepad, guys, make notes, and backtest. The understanding you will learn between these two is the foundation to building the anticipatory skills for price movements and understanding where the market is likely to draw to. Now, what is internal and what is external range liquidity? Internal range liquidity, or IRL, is defined by fair value gaps, so imbalances on your chart. External range liquidity is defined by old highs and old lows. When external range liquidity is taken, a fair value gap becomes the next draw on liquidity, and when a fair value gap is tagged, an old low or a old low, and when a fair value gap is tagged, an old low or an old high, external range liquidity becomes the next draw. Now we have a crude schematic over here on how to see where internal and where external range liquidity is. We've got this move up starting from here, so we have external range over here, which is an old low, right? We move up, going down, 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 taking out that low. So that is external range liquidity, right? Because there's an old low down here. Now, price only does two things, right? It goes to old highs and old lows, or seeks to reprice into imbalances. So in this range where we draw lower from, there was a fair value gap or an imbalance up higher. Price took out external range liquidity. So what is the next thing price will do? Price will draw to internal next, which is that fair value gap. So think about it, when you see an old high or a old low get rated, you want to either look for an imbalance inside that range to get repriced into, right? And then once that gets hit, we can move for the next one, which is external again. Same over here, only reversed, right? We have external range liquidity over here, as in an old high. Price moves lower, forms a swing low, expands up higher, taking out that external range liquidity. In the process of taking out that external range or old high over here, we form an imbalance down here, which could be a fair value gap. Then price moves back into that fair value gap after taking out external range liquidity, right? And then when we hit that internal range, we want to go for external again. As explained earlier, price only does two things. It draws to old highs and old lows, and it rebalances an imbalance. So there's literally nothing else price does. And with that in mind, it becomes very clear after you see old highs or old lows getting rated. What are we going to look for next, right? We're going to look for an imbalance where we can trade into. And let's say we are in bearish order flow and we take out an old low. There's probably a fair value gap in a premium level on that same structure. We can look to trade and buy into that old, after that old low has been rated, we can buy into that fair value gap. And once that fair value gap hits and it respects it, we can look for external range again, right? The flow of the marketplace is that internal range liquidity being tagged will be the catalyst for price to draw to external range liquidity, and vice versa. And external range liquidity being taken is the catalyst for price to draw to internal range. So it's only this, and it repeats as simple as that. After time, it repeats like this, external to internal, internal to external. Using this understanding on the monthly, weekly, daily and 4-hour is the key you've all been looking for when it comes to daily bias. Alright, we've got a Australian dollar, US dollar monthly chart over here. Now, let's look where is the monthly external range liquidity over here, right? So we rate this external range. Now, without going further, where does your eye draw into? You should be looking at a internal range liquidity in the form of a fair value gap, right? So after external gets rated, where do we want to reach into? We can see this imbalance down here, which is a fair value gap, right? So if you looked at this area after we got this external range liquidity rated, you're on the right path. And we can see this monthly internal range liquidity in the form of a fair value gap gets stacked. Now, what happens afterwards? Right? Let's look at this from a daily perspective, right? We take out the monthly external range liquidity. Now, using daily structure to frame our setups, what are we gonna be waiting for? After this monthly external range liquidity has been taken, we're gonna look for a monthly internal range to be the drawn liquidity. We have this outlined down here. Now, we need to wait for a little bit of confirmation, as always, right? So we wait for a break of structure. That happens after we rate the monthly external. Break of structure down here. Return back into premium. And it continues down into that fair value gap. Example of AUD USD monthly chart. As you can see, external range liquidity defined by the old high gets taken and price starts to trade away from the high. So your eye should immediately go to that bullish fair value gap below market price as the next drawn liquidity. Because external range liquidity being taken is the catalyst for price to draw to internal range liquidity, which is that fair value gap. When we look at the marketplace with this understanding of the relationship between the two, and we blend it with the higher time frame charts, your understanding of price and where it's likely to draw next should really start to materialize. We can see just from this understanding on the relationship between the two being used on a higher time frame monthly chart, we have managed to frame a bearish bias for the whole 2 months. So think about it, right? You can have a clear draw on liquidity for 2 entire months. Alright, we've got a GBP AUD weekly chart over here. Again, let's look at it from here. Weekly external range liquidity has been taken. Where is your eye drawing to? Do we see any imbalances down here? Nope. Where do we see an imbalance? Right down here. So with that imbalance being present down here, this fair value gap, your eyes should immediately go there for the next draw on liquidity. External range has been taken, so what are we gonna look for next? Internal range, right? Weekly internal range liquidity over here. And it draws in there perfectly. Now we've hit that weekly internal range liquidity. Think about it, right? External to internal. Now we're in internal. Where are we gonna draw into next? Where is your eye going? Right? External range liquidity over here. It's as simple as that. External has been rated over here. We draw back into internal. Internal has been tagged. Where are we gonna go? We're gonna go to external. It's simple as that. So that weekly external range liquidity, that old high has been liquidated after going into internal. And looking at the daily chart, now we can see how we can frame our bias on the daily, right? So this was the draw on liquidity. We're drawing lower, 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 right? And then hitting that weekly internal range liquidity. So we went from external, remember, back to internal. Now we've hit that internal range liquidity going into a market maker buy model, right? This is the sell side of the curve over here. Then we're going into buy side of the curve over here because we hit a higher time frame discount array, right? It's a fair value gap. So now we're gonna reach for external range liquidity. And the first external range liquidity, which is very obvious, is this long wick here, right? So we're gonna eye up this liquidity, which is also a break of structure after we hit that higher time frame array. Now, when the market displaces over here, we have internal range liquidity formed, right? So again, we go from external over here where do we want to go? We have internal, right? Back into internal. And after we hit that internal, where do we want to go? External again, right? So we have this old high up here, which is external range liquidity. And you might think, well, wait a minute. I thought this was external range liquidity, right? But in this whole bigger range, every swing high or swing low is external range liquidity. And that, remember, internal range liquidity will be that fair value gap we're looking for to mitigate with and continue up. So same case over here, we take out this external range liquidity. Again, where are we gonna go? Do we see any fair value gaps? Yes, we have this one. And we have a fair value gap down here. But why are we not taking this fair value gap? Right? This has something to do with premium and discount. Obviously, if you take this range high to this range low to this range high, this fair value gap is in premium. So it's more likely it will draw into this discount fair value gap, right? So keep that one in mind. Market draws to that internal fair value gap in discount, right? Of this range, swing low to swing high. Continues up again. Where are we gonna go after we take this internal range? Again, it's on repeat, right? External to internal to external to internal, and it keeps going and going. Again, external range liquidity over here after we take that internal range. So we went from this internal on a higher time frame, right? That weekly internal range liquidity as the fair value gap, and now we're on a daily chart and we can see day after day we're looking for external to internal to external to internal. Again, back into external. Right? Now we've hit that external, that extreme high up here. What do we want to do? We want to go back into an imbalance again, right? There's another imbalance down here in the fair value gap, and it keeps on going into internal and then draws back into external. So literally it's external to external on repeat. Again, external, and then all the annotations together, you can see how this is forming, right? Think about that extreme high. We're going to, and this high, we rated an external range liquidity over here. Remember, so we're drawing into a weekly internal level. Weekly internal level is down here, right? That fair value gap. Now we're looking for a buy program, buy side of the curve. We're going to an external range here, back to internal, to external, to internal, to external, to internal, and so on and so on. Knowing the relationship between the two is what leads us to a high probability daily bias. You can see how many intraday opportunities we just had with the understanding of the relationship between internal and external range liquidity. Alright, we've got a USD dollar index daily chart. Again, example after example, and this is what you need to see. You need to train your eyes for external to external, and it will make your reading of bias a lot better. And sometimes you don't know what is the draw on liquidity, but with using external to internal and internal to external, it will make it a little bit easier and, might I say, more accurate. So over here, external range liquidity again, right? What do we do after we take external range liquidity? So what do we do after we hit external range liquidity? Again, we want to go to internal range, right? So where is internal range liquidity? We've got this big fair value gap up here. Price reprices back into that imbalance over here. So we hit that internal range liquidity. What do we want to do after we take internal range liquidity? Go back to external, right? We fill this up. We look for this external range liquidity down here. And we keep declining. We take out this external range. Where are we gonna draw into next? You might have guessed it already. We're going to internal again, right? You can see it draw lower, going back into internal down here. Keep declining, taking out a low. There's no imbalance anymore over here, so price has issues going up way higher than here, and it just keeps declining, taking out this external range liquidity. Now, we took external range liquidity. Do we see an imbalance anywhere, right, where we can reprice into? Yes, we have over here, we have this daily fair value gap, internal range liquidity. We've got a British pound Swiss franc daily chart over here. Again, example after example. Keep repeating this. Down here, external range liquidity, old swing low, right? Over here. And might I add, we have a rejection block here, right? This long-wicked area over here, which is pretty deep in discount, right? Don't forget about your discount and premium levels, which is this whole range, right? So we're pretty deep in discount. We rate a swing low, which is external range liquidity. Now where does your eye draw into? Right, we have this candle's low to this candle's high, forming a fair value gap up here. Price draws in there after we take external range liquidity. So now what are we gonna do after we take this internal range liquidity? You've guessed it, we're probably gonna go into external range once again. So looking at a 1 hour chart makes the structure look a little bit easier to read, right? We have clear sell side of the curve over here, leaving that fair value gap on the daily time frame. After we take out this external range liquidity, we can actually see where 1 hour chart starts to break up and starts to break structure up here, right? Break of structure, return back into discount levels, repricing this internal range liquidity, right? External over here, back to internal, continuing up, 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 taking out external. Where are we going next? Back to internal, right? Fair value gap down here. And then we're gonna go for external again, which is this daily fair value gap. So we went to external on a 1 hour chart, and on the daily it's a internal range. So for some of you it's gonna be easier to spot than for somebody else, but in my experience I found it most easy to see external range to internal range first. So we wait for an old high or a old low to get rated right, and then we don't want to trade into an imbalance as a clear draw on liquidity. If you find it easier to spot external range to internal range, you can just stick it with it like that. You can also go from internal range to external range, which could be a OTE entry, right, into a range on a fair value gap, and then aiming for an old low or an old high. You don't ever have to trade internal range to external range, and the same goes for those of you who can see internal range to external range. Important is what is most comfortable for you to see. So let's summarize internal to external range liquidity. The relationship between the two being used on the monthly, weekly, daily and the 4 hour chart is the key that unlocks your understanding to bias and builds the anticipatory skills required to forecast market direction and where price most likely will move. One of the biggest misconceptions regarding low resistance liquidity runs is there are only fragile patterns on a chart like trend lines or equal highs or equal lows, that kind of patterns, but that is valid. However, true low resistance liquidity runs are framed off the higher time frame PDRAs, right? So think about that, monthly levels, weekly fair value gaps, and so on. The higher time frame monthly, weekly and daily charts are the catalyst to one-sided low resistance liquidity runs occurring in the marketplace.